there's so much I was wrong about in 1999, but I thought I'd reflect on some of the things I was thinking at the time, give some perspective on what it means for the world today of 2022. And when I was running PayPal, when I was getting it started, the standard way I'd start an investor pitch I'd hold up several $100 bills, and would always get people's attention. It's kind of hypnotic, even though, it's really weird. What is this? I mean, it's probably not very good as toilet paper. It's not good as wallpaper. It's sort of this crappy fiat money. It's a very mysterious thing. What is money? Is it a network effect? Would the gentleman in the front row like to have the money? Does somebody come up and get it? But I don't know how to throw it out at people. I thought you guys were supposed to be Bitcoin maximalists, And so this is like, it's like kind of crazy that this stuff still works, But when we were starting PayPal, we knew nothing about money, about banking, about payments, about any of this stuff. It was sort of all thought of from first principles. We probably got a lot very wrong. I'll mention the two slides that describe what we thought we were doing. This is the PayPal February 1999 seed round pitch. We were going to replace, we said the US Treasury, we actually meant the central bank. We didn't know the difference between the two. But it was going to be sort of a closed loop system, a new form of money, new network effect, electronic 21st century version of money. By 2002, at the time of the IPO, the PayPal business model looked like a funnel where the money went in and out fast. And it was a payment system. And I wanted to just start that those two pictures, a closed network versus a funnel, are two very different pictures. In some ways, this was a more practical business, but it was a decline. It was much less ambitious. Money goes in and out super fast. And I think one of the ways to think about all of these different things, this is not a perspective I had at the time, but if you think about these different forms that money can take, you can have forms of money that are high velocity, where it moves super fast, but then you don't actually need that much in the form that it has. It's just like maybe an accounting device or something like that. And if you have forms of money that are intrinsically low velocity, then the quantity you need is much, much greater. And it's this inverse relationship that goes across many different forms of money. And so the PayPal 1999 was a closed loop where you'd have this enormous store of value that gets built up. The PayPal 2002 was sort of a high velocity loop. And this is, of course, also analogous to something like gold bullion is store of value, low velocity money. It moves once, every few decades in a central bank vault. Visa, super high velocity, moves trillions of dollars a year, but Visa itself doesn't need to have very much money on its own. And I think one of the reasons people always get these two different modalities confused, and they're like radically different kinds of products, is that when we think of money, we are still always just thinking of the $100 bill that I presented you at the beginning. And physical cash it's sort of the one very weird form of money that's actually sort of intermediate velocity and intermediate value. It's not really great at either. You can store money in a piggy bank, physical cash. You store it in a mattress. That's getting pretty weird. You can maybe use it to buy, pay for a restaurant or club, maybe a used car. Probably gets hard to use physical cash to buy for a house. So it's sort of both. It's not that great at either payments or store of value, but it's in between. And because we always think of physical cash when we think of money, we tend to think store of value and sort of high velocity things are the same, even though in practice, most things are at these two opposite ends of the spectrum. And then, I want to obviously suggest that, Bitcoin and Ethereum are at these two extreme opposite ends of the spectrum. Bitcoin, store of value, gold replacement. Ethereum, if it works, is going to be sort of the super high velocity, fast moving thing. And the thing that's sort of, I would say, fundamentally honest about Bitcoin is that we are just at this one, sort of low velocity, high value end of the spectrum. And then if you look at something like Ethereum, you are you will say that it's high velocity, it's going to be sort of a frictionless payment system, but then it's also going to have incredible amounts of intrinsic value, and there's probably something about all those things that doesn't quite add up. So if this is, by the way, I took this slide from Vitalik himself. So this was and there's sort of a question: how do we compare and contrast them? And so if we look at the current market caps, 830 billion versus 386 billion of Ethereum, but if we map Bitcoin onto gold and Ethereum onto Visa, well, Ethereum's worth roughly as much as Visa, so it's fairly valued. If you have a seamless, frictionless payment system, it's worth $400 billion. As it works, the gas fees have to go down. It has to become completely frictionless to work. And then, whereas gold is 12 trillion, and if Bitcoin is going to replace gold, the question is really, why is it so undervalued? What is it going to take for it to go up to the 10x? And I'm going to close on that a little bit later. So there sort of are all these different ways Bitcoin has every potential to replace gold. Question is why it has not done so yet. Now, I think if we take one step further back, we can even ask a question: why is gold worth $12 trillion? How much should all the gold in the world be worth? And if we look at, say, the 1970s, gold did remarkably well, stocks were kind of a crappy investment, and it's sort of very different from today. So if you look at all the gold in the world today versus all the publicly traded equities in the world today, it's about 12 trillion of gold, 115 trillion of equities, roughly a 10-to-1 ratio. If you look at sort of the peak of the bull market in the late 70s, early 80s, where gold peaked at about $850 an ounce in nominal dollars. At the time, all the gold in the world was worth about $2.5 trillion. All the publicly traded equities were worth $2.5 trillion, and the ratio was actually 1-to-1. And so one of the questions you have to ask is, why is the ratio 10-to-1? Why can't it be 1-to-1? Maybe it should be 100-to-1. It can be all over the map. What defines these kinds of ratios? And I would say sort of one simple version is that in the 1970s, cash was trash, bonds were trash, but equities were pretty bad investments as well, because in an inflationary world, in a high regulation, high inflation, high tax world, the effective capital gains tax rate goes well north of 100%, because you don't set the basis on equities, you don't adjust it to inflation, and so equities become an extraordinarily bad investment. In the world of the 2010s, gold did pretty well, Bitcoin did extremely well, but the real competitor for Bitcoin is not Ethereum. That's a payment system. It's not even gold. It's something like the S&P 500. It's the stock market as a whole, and this is the way Bitcoin trades every day. If the stocks go up, Bitcoin goes up. Now it's like a highly levered Nasdaq stock on a day-to-day basis, and that is sort of, in a sense, the real competitor. And the question is whether we're headed towards a kind of 1970s style world where it's higher inflation, more regulation, and even being, you don't want to be in a stock or bond, but even being, you don't want to be in cash or a bond, but even being in a stock, you're effectively in something that's like a government-linked entity. Woke companies are sort of quasi-controlled by the government in a way that Bitcoin never will be. And in that sort of a world, I would submit that perhaps the way we should think of the Bitcoin to equity ratio, the benchmark for Bitcoin is not gold, but equities. And the question is, why can't there be parity between Bitcoin and equities? Why shouldn't we be talking about something more like 100-to-1? Which, of course, won't be as good as it sounds, because the fiat money will be worth a lot less, and it'll be taxed pretty heavily and whatnot. But I think, I'm still hopeful that if Bitcoin goes up by a factor of 100, you'll make some money, a modest amount of money, in real terms. Now, there are sort of at the very minimum, what I think, it's always hard to know where Bitcoin goes from here. It's $43,000 today. Where does it go? What I like to say is that Bitcoin is always the most honest market in the world. It's the most efficient market, and it was the canary in the coal mine. It was telling us that the inflation was coming in the last 2 years as it went from 6,000 up by a factor of 10x. It is telling us that the central banks are bankrupt, that we are at the end of the fiat money regime, and that's sort of what it has priced in. I think the central bankers, Mr. Powell, people like that, should be extremely grateful to Bitcoin because it's the last warning they're going to get. They've chosen to ignore it, and they will have to pay the consequences for that in the years ahead. Let me come back to this question. Why has Bitcoin not yet gone to 100,000 to $1 million of Bitcoin? Why has it not yet converged with gold, or even with the equity markets more broadly? And what is it going to take for this to happen? And I know that sort of the ways we often talk about businesses or technologies is how great the technology is, how great the code is, how great the math is, how it's sort of innovative. But I want to sort of suggest that we should maybe think of it at least in one dimension as sort of a political question. And it's a movement, and it's a political question whether this movement is going to succeed, or whether the enemies of the movement are going to succeed in stopping us. And so I want to maybe end with an enemies list, a list of people who I think are stopping Bitcoin. And they all have, many of them have, there's sort of a lot of them. They tend to have this sort of nameless, faceless bureaucrat perspective, which is of course one of the ways they hide. But we're going to try to expose them and realize that this is sort of what we have to fight for Bitcoin to go 10x or 100x from here. So, enemy number one. I think he's sort of. I think the sort of the sociopathic grandpa from Omaha is perhaps the most honest and the most direct in it, and you have to sort of think of it's of course on some level these people aren't always just talking their book. It's sort of they have some sort of institutional bias. It's long, a list of woke companies. It's somehow long this fiat money system, and of course, there's always a sense if you're a money manager, you want to pretend that it's complicated to invest, and if all you have to do is buy Bitcoin, that's like ridiculous. All these people are out of business. There was a version of this also with gold. They never liked gold either because if all you had to do was own gold, that's something everybody can do. But there's sort of an institutional bias, a sort of a center-left political bias. There's of course the New York City banker bias. Jamie Dimon, J.P. Morgan. You can get quotes like this from any number of these people. And then I would say. Another one, even more obscure, Larry Fink, the CEO of BlackRock, where, if you have these sort of large institutional investors, they need to be allocating some of their money to Bitcoin. When they manage state pension funds in the US, or they get trillions of dollars in assets, when they choose not to allocate to Bitcoin, that is a deeply political choice, and we need to be pushing back on them. We need to say, you have to get on board on this. And the Larry Fink quote is sort of representative, I think, of a whole genre of anti-Bitcoin things where, and you have to always put it in some context, but pro-blockchain is an anti-Bitcoin term. very typically. So it's like, I love the blockchain, but not so sure about this Bitcoin. Don't need Bitcoin. We can move on to the blockchain. Move along. This is not not the currency you're looking for. Move along. Move along. But if we sort of combine all of these things, I would sort of put the label on the sort of on the sort of the label they've come up with, and perhaps the real enemy is ESG, and which it's always sort of unclear what it means. You might think of it as not charitable for me to sort of name some enemies here, but I think that ESG is just a hate factory. It's a factory for naming enemies, and we should not be allowing them to do that. Or that of course you can sort of always ask the question, what's the difference between ESG and CCP, the Chinese Communist Party? They are into social and governance. Environmental is sort of fake. It's probably also fake in a lot of these cases. But I always think when you think ESG, you should be thinking CCP. There's some degree. It's been a surprise. ESG has been surprisingly inclusive. Basically, as far as I can tell, the only things that are sort of not liked are some of the carbon industries, and then Bitcoin. And it's because most of the other companies, they are subject to political control, especially when your companies go public. I always advise CEOs when they take their companies public. There's some good things. You get liquidity. You can, the early investors can cash out. You can get some credibility. But it's basically taking a company public. It's a de facto government takeover where some people who are effectively government bureaucrats became more empowered. It's the CFO, the general counsel, the accountants, the lawyers, the HR people. All these sort of extensions of the state are given more power, and we have to think of ESG as sort of this vast umbrella thing, and we're sort of one of the great features of Bitcoin, and it's always a question whether it's a bug or a feature, but I would submit that in the sort of more heavy-handed statist world, it is far more of a feature than a bug, is that Bitcoin is not a company. It does not have a board. We do not know who Satoshi is. And in some ways, all these things seemed extreme in the world of the 2010s where, the inflation was low, the regulations were not the worst. And it seems extremely prescient for the world of the 2020s. And if we had to summarize this in one frame, the finance gerontocracy that runs the country through whatever silly virtue signaling / hate factory term like ESG they have, versus what I would call, what we have to think of as a revolutionary youth movement. And we have to just go out from this conference and take over the world.